Hey all, looks like we got about half the class on, so I'll give it another 30 seconds to a minute before I get started here. Sam's got a camera. I saw you there for a minute, Sam. I know you're legit. So you go off camera now that you proved you were a real person on the other end of the line. I got you. I got your credit. Caleb, you're good. Alexis, you're good. You got me fooled. Go ahead and watch your Monday Night Football now. So I'll never know the difference. Speaking of which, this is the least enthusiastic I've ever been about teaching a class, and it has nothing to do with you all. If you get my message, you know I got called away on business. I was supposed to be in Las Vegas for a meeting tonight, and afterwards we were going to go watch Monday Night Football, and I'm sure what will be one of the nuttiest nights Vegas has seen in the last several years. But yesterday, my wife tested positive for COVID, so I am currently quarantining in my home office. So no fun for me tonight, but it does give me a chance to teach via Zoom, and I hope this works for everybody. It's nice to have the Zoom room set up just for instances like this where we can't meet face to face, since we are kind of every other week anyway. I want to make sure that we got some time to meet and get some questions answered, and offer maybe a forum for complaints if any of you have run into challenges with the homework or the online tutorial or whatever. So tonight's agenda is to take some questions. We've only gotten to meet once so far. Last week was one of our YouTube videos, so I want to find out how that went. I want to find out how everybody's doing. Are you on track? Are you off track? Do you have questions? Did you get yourself a company picked and successfully submitted via the online forum? That's a big one. Proxy analysis, and then after questions, I want to talk a little bit about the exam. I mean, believe it or not, we got the first exam coming up here in 2 weeks. So I'll talk a little bit about the format about that, and then I'm going to launch into a lecture over module 3 tonight. Module 3 is really dense. There's a lot of materials. If you've downloaded the PowerPoint slides, there's over 80 slides associated with that module. I won't be able to cover them all tonight. I'll get as far as I get, try to take some questions, and then I want to direct you to some additional materials that'll kind of bring some of that to life as you get into the homework. Fortunately, I suspect a lot of you have run into these materials before, so probably be a review for many of you. But before we get into that, give me a status check. How you guys doing? I really appreciate it when we can take time at the beginning of class to answer all the questions, rather than if you have a question trying to catch me before or after class, because my experience has been these classes are big enough. If you have a question, somebody else does too. So it's really beneficial to kind of address them first thing. And you'll find that I don't have all the answers. It's as likely as not that somebody in this class has already ran into the same question and troubleshot it. For example, I was going back and forth with somebody this week. I forget who, I apologize. But the question about the homework. And they were having a lot of trouble getting the right answer in the My Business Courses homework, because they were instructed to round when the correct answer was actually truncated. So for example, if your ratio was 18.769, you don't round up to 18.70, you just leave it at 18.76. So you just truncate instead of round. You would have no idea if he hadn't reached out to me, who's been through this class 10 times. So I know that's one of the little, I guess, call it a bug associated with text. So what's on your mind, gang? How's it going?
Good. When you say maybe you've downloaded the slides for module 3, you mean out in what do you call it? The slides, well, they go along with the book, whatever the website, my business course stuff, right? There's not other slide content somewhere, right?
No, there's not other
Canvas.
slide content, and they're all on the Canvas site.
Okay.
So if you go to our Canvas site under course resources, you got all the slides there. More importantly, as I reviewed a couple weeks ago, you have the solutions manual out there.
Right.
Yeah, so make if you didn't catch class 1, make sure you download that one and use it to your advantage. Okay, no other questions? Everybody got a company. Everybody will at least find the proxy and do a little bit of work to kind of discover how your management team gets paid, which is all there is to that proxy assignment. Read the proxy, find out how your management team gets paid. If you run across any unusual conflicts of interest, point those out, because they can be interesting here. Okay, chat, here we go. Was there additional detail or examples on what the proxy analysis was supposed to look like? I felt at a loss on how to get started on writing that analysis. And I guess my advice there would be, if you're kind of running into just troubles on how to get started with that, you're probably overcomplicating it. Simplify it to that one simple question: how does my management team get paid? And you're going to find their salaries pretty easily. But for most management teams that work for Fortune 500 companies, their salary is a fraction of their total comp. There's going to be incentive comp that's detailed in that proxy. Find out what that incentive comp is, and then find out how the management team is incentivized. That's what incentive comp is. It's linked to something. What is it linked to? Is it linked to earnings per share? Is it linked to share growth? Is it linked to return on assets? Is it linked to total revenue growth? Is it linked to certain ratios, return on invested capital? All of these things that I've just mentioned, I have found embedded in various executives' compensation packages. They're so varied, which is why you really have to dig into the proxy to find out what it's linked to. And then as we're going through the material tonight, that's the thought exercise that we're going to try to engage in every week, which is, okay, maybe we get to return on invested capital or net operating profit margin, and you've already discovered that your management team gets paid based on that. And now your challenge as an analyst is to ask yourself the question, okay, some of this accounting can be manipulated. If you wanted to manipulate the accounting for your benefit, meaning now you're the CEO or you're the CFO, how would you do it? And that's the kind of skeptical eye that I'm trying to ingrain in everybody that comes through this class throughout the semester. And I think that skepticism will serve you well in the long run.
So quick question on that from a skepticism standpoint. So
yeah.
I've had compensation based on stuff like that in the past, and it's typically been difficult to like max out the percentages. For my company, they hit 350% of their target or whatever. So everybody maxed out. Are those typically easy layup targets just so they can get paid incentive compensation, or are they, are they meant to be easy money, I guess?
They can be, yeah. If you have a bunch of cronies on your board, then you can see that, and that's important to point out. If you feel like the board or the compensation committee of the board is setting easy targets for your management team, well, that's not really what you want to see as a shareholder. That's probably not going to make you real excited about going out and buying the stock. I wouldn't be as an investor. I want to see some stretch goals in there. So yeah, come to some determination about whether or not you believe those are good goals and why, and then we'll kind of backfill that opinion over the course of the semester, and all the work that we do will either kind of corroborate that story, or it'll get a little bit more nuanced. Okay, Kelsey asks, would we be able to submit the note card assignment via email since class has been moved online, or do you want to wait until next in-person class and submit a hard copy? You can just wait till next in-person class and submit a hard copy. That's fine. There's no urgency around that. When I get the note cards, I'll begin to try to commit them to memory. Okay, let's talk about the exam. Okay, the exam is an online exam. I'm going to share my screen here and just go out there. So beginning next week, let me go over to the internet here. When you come log in, okay, can you see my screen? Okay, I got a nod from Connor. I'm gonna call that good. Okay, here is the My Business Courses class. And I'm going to go to Fin 5561, go to course. Under module 4, you can see exam 1. Now I've already created the exam. I just need to open it. When I open it, I'm going to send you all an email and let you know that the exam is open. I typically don't open it until after we've covered all the material. So at the close of class next week, which is another recorded lecture, we will have covered all of the material for modules 1, 2, 3, and 4. I will open the exam probably next Monday night, and I'll leave it open for a period of 2 weeks. So anytime inside of that 2-week period, you're going to be able to come out here, click on this exam 1 test, and you're going to open up a 40-question multiple choice exam, and you're going to have an hour and a half to take it. It's so that gives you, what's that? I don't know, 90 minutes divided by 40, a little over 2 minutes per question. Be smart about how you take that test. When you only have 90 minutes, you know, some of these are problem type questions, and you'll be able to look up some of them, but you won't be able to look up all of them. And that's kind of the gotcha nature of an open book, open note exam. Which is you have to know the material to make it through all of the questions on the exam. And, you know, Clayton says 2 weeks question mark. Yeah, I can confirm that. I'd leave it open for a long time because I want to accommodate your all schedules. And in this virtual world, we have the ability to do that. And I've been able to set some controls and parameters around that exam that I feel like make it pretty fair. The average score on the exams is usually in the mid to low 80s. So it's tough. It's a tough exam. And that's one of the reasons why I put so much time into, you know, kind of the night 1 explaining the way I designed this course with so many homework problems and, you know, points available from the research assignment so that the exams aren't crucial. You don't have to ace the exams to get an A in this class. They're designed to really test your knowledge of the material. Okay, any questions there? Okay.
Can you take the sample exam as many times as you want?
Yeah, that doesn't go anywhere. Just click on that as many times as you want, and that'll be good review. Another question in the chat: are the homework assignments the best way to review? The homework assignments are really good. The homework assignments are really good conceptually. They force you to recognize, you know, how to apply the materials. And the format of the homework is mostly problems, so that works well for homework. The exam's multiple choice, so some students get kind of caught up in the different formats. If you don't conceptualize the material, then it doesn't translate between the problematic nature of the homework and the multiple choice nature of the exam. And I think it's really the reading, maybe watching some of the lectures associated with the text that helps to seal that in, lock it in. So do both. It would be my recommendation. Okay. If something comes to mind, type it in the chat. I'm gonna try to monitor that, or just interrupt me. Okay, Clayton asked, so all the questions are multiple choice? Yes, no fill in the blank like the homework. No fill in the blank like the homework. Might be a true false in there. And well, you all know how multiple choice exams work. Sometimes they can try to get you on technicalities. The multiple choice questions, they can be kind of gotcha in nature. I try to go through the exams, and if I see any BS like that, I kick the questions out. But if you take the test and you get your score back and you're looking through it and you're like, oh man, that's pretty weak, just bring it to my attention. And if it's a poorly written question that I don't feel like tests your knowledge of the material, I'll give you the points for it. I mean, what are we doing here? We're in class to try to learn something. So sometimes multiple choice tests are a good format for that, and sometimes they're not. If you can exhibit to me that you had a grasp of the material at hand, then I'm going to give you the grade. I'm not a stickler for the technicalities of academia. Okay, in night one, I was trying to find something associated with this course, and I couldn't do it because we moved from version 5 of the text to version 6 of the text. But when you log in, if I go back to Fin 5561 here, when you log into this experience, which is right here, the textbook pops up and you can click on this read. Okay, and I suspect most of you probably found this. And I toggled over to module 3, which is what we're going to be talking about tonight. And you can see it's all right here for you. This might be easier for some of you than the real hard copy text. You know, I'm an old man, so I still like to have the real hard copy in front of me where I can highlight and underline, but I suspect there's probably a lot of people in this class that do better in a virtual version of this. Well, if you scroll through here a little bit, there's a lot of great resources, and I just want to make sure that everybody in class understands that. Let's say you click on review 3.1. So you're going through the material, maybe you're in the homework, maybe there's 8 learning objectives in module 3. Maybe you're nails on 6 of them, but there's 1 or 2 that you're like, that one just didn't quite click. Well, you come out here to the text, you click on this review. Now look at what you got up here. You have instructional videos associated with each one of these. So for any of this materials that's review, I mean, be smart about how you use your time. If you don't need to be spending time on something, don't spend the time on the material that you're weak on. And you can come out here, you can click on that little button and a video is going to pop up.
In lecture, we focus on our second learning objective. We apply the disaggregation of ROE into return on equity.
Great. Now you got 9 minutes about the DuPont method, which we're talking about tonight. This is great review material. All these lectures that I have posted to YouTube, yeah, you may find that you like these lectures a lot better than what I do, and that's fine. They're packaged for you in bite-sized chunks. I think they're complementary and a terrific supplement to what I do. I mean, for a couple of these lectures, it's just like anything else in life. If you don't use it, you lose it. Every time we get to module 10, I'm kind of scratching my head on, the accounting for defined benefit pensions. I'll come out here and watch these. They're a great refresher. So make sure you use that resource. It's really good. Okay, let's talk about module 3. Let me switch these. Okay, now you all should see a big module 3 presentation. I got a couple of, anybody nodding their head there? Can you see my PowerPoint? Okay, great. Let's do it. Okay, tonight we're going to be talking about return on equity, which is the beginnings of profitability analysis. It answers the very basics of questions that investors want to know, which is what kind of return are we getting on our money? And investors are, by definition, equity investors. So we're going to start with return on equity, and we're going to work our way back up the balance sheet as we disaggregate that. Because as you'll see, return on equity has a dozen different subcomponents. And as we disaggregate it or kind of pull it apart, we're unraveling a story. And that story tells us a lot about how a company is being managed. So when we look at return on equity, we can disaggregate that into profit margin and asset turnover and financial leverage and so on and so forth. As we look at the variability from one year to the next, it's your job as an analyst to understand the drivers of that. You know, what's driving changes in return on equity? Is it pricing? Is it margin? Is it turnover? Is it days sales outstanding? All of these ratios are extremely important to the analyst because every one of them tell us part of a story. And it's usually just enough for us to say, okay, well, I can kind of see what's driving the change here. Now I need to pick up the phone and reach out to management team and get some real clarity on what the competitive dynamics are in the industry that's really pushing those numbers. So you'll see here the formula is really pretty easy. We're going to take net income and divide by average stockholders' equity. So I want to give you a little disclaimer here on this word average. Even the authors of the text are not very good about using the average. The average is technically correct. You want to take net income, which accrues over a 12-month period, and divide it into the average shareholders' equity over that period. In practice, what you see is analysts just use end of period equity as shorthand. So if you get to the homework and you're just beating your head against the wall because you can't make something work because you're using average, try end of period and see if maybe the authors have used that same shortcut. Happens all the time. It's not technically as accurate, but if stockholders' equity hasn't changed much year over year, it's probably pretty good for whatever purposes you're using it for. And that's the difference between being a financial analyst and an accountant. And as an accountant, you have to get it right to the second decimal point. As a financial analyst, we're using this data to make decisions that could affect our future 3, 5, 10 years in the future. Maybe it's M&A activity. Maybe we're trying to decide what kind of stock to buy. We don't have to get it right to the second decimal point. We can't get it right to the second decimal point. The best hope we ever have is getting directionally correct. You know, is the stock going to go up or is the stock going to go down? So for those purposes, a lot of times it makes no difference whatsoever whether we use average or end of period. And I think that's a very important distinction for what we're trying to do, because these aren't GAAP numbers we're working with. Return on equity is not a GAAP number. Return on equity is a tool that we use to inform our decision making. So just like any good craftsman, we can use that tool however we want. If we want to use the screwdriver to pound a nail in the wall, we can do that. So it's important to know the purpose of the whole exercise, and that really informs how we're going to use this. Notwithstanding, this is a multiple choice test, so you're going to need a little bit of accuracy if you are trying to use this formula. Okay, some pretty simple calculations here. You know, for this type of stuff, I'm not going to go into this tonight. I think this is there's a whole bunch of slides in here that take what I think is a pretty simple formula. I mean, it's formulaic. You take this piece, you take this piece, you take this piece, you put them into the formula, you do run the calculations, and then you spit out a return on equity. Okay, you all can handle that without much additional input from me. What I want to focus on is the usage, the conceptualization, and then maybe some additional context, which is right down here. And I think this is great information for you all to know. The return on equity for S&P 500 firms ranges from 13 to 16. I mean, if you look at these dates, and you can go back, you know, there really wasn't a recession in here. 14 to 18 was predominantly a bull market or an expansionary period. If you're looking at a recession, yeah, you can see these return on equity numbers go down significantly, but call this a quote unquote normal market period. Yeah, that's about where you're going to range. So if you've selected a company for your case study and you have a return on equity of, I don't know, 3%, Well, now your job is what happened last year that return on equity was so low, and why? And probably why are competitors doing so much better than maybe your firm? So tonight we're going to be using Boston Scientific, or the chapter, the authors use Boston Scientific as a case study for a lot of this return on equity work. You might just note that Boston Scientific was number 97 on the S&P 500. That's a med tech company. They make stents, heart stents, as well as a whole bunch of other med tech type stuff. The S&P 500 accounts for 75% of the US stock market. And I think I'm a little fuzzy on these numbers, but I believe 40% of the total revenues that accrue to companies in the S&P 500 are actually international revenues. So like take McDonald's. McDonald's is in the S&P 500. A good portion of their revenues come from overseas. Same way with Apple, same way with Google. Pick any company in the S&P 500, you're going to see a similar story. That's why people use the S&P 500 as such a common bench. It's 75% of the US and 40% of those revenues come from overseas. It's a pretty good global benchmark. And that's why most investors are using it to compare their returns to. And also why, well, a couple of years ago, I don't know how, maybe some of you in this class follow Warren Buffett. Warren Buffett had a very well publicized bet with a hedge fund that ended in 2019, and it was a simple bet. Buffett said, "I'll bet the S&P 500 beats your hedge fund, and all hedge fund as measured by an index of hedge funds over the next decade." And I mean, the S&P 500 just crushed it, and I think Warren collected $1 million on that bet. It all went to charity, but it was pretty fun for their shareholders to watch. I get passes to that meeting every year, by the way. If anybody ever wants them, reach out to me, let me know. It's an awesome meeting. It sounds like it would be like watching paint dry, but those two old codgers, they sit up there in front of a card table and they yap for 4 hours straight about what's going on inside their business. And they got a little routine down, and it's like this Abbott and Costello show, and it's really, really good. And you'll pick up some nuggets of wisdom that have powered that company to unbelievable success over the years. Okay, we're going to look at two methods of breaking down return on equity. The first one is DuPont analysis. It's the simpler of the two. Then we're going to complicate it in a big frickin' way with an operating focus. And I'll be honest with you, I go back and forth about this operating focus with regard to how much additional value it really brings us, because it is a lot more complicated. But I'm gonna try to explain and draw out why we would want to go down that road, because there are instances where an operating focus is much more meaningful to what you're trying to do. And for me in my career, that was really when I was doing corporate finance. I was working for, this was at the turn of the century, I was working for Sprint. We were doing competitive intelligence on the whole market. So we wanted to understand our operation as it related to AT&T and Verizon, and at the time it was Singular, which was really Southwestern Bell, T-Mobile, which was Deutsche Telekom, and a few others. So we would take the 10K filings and basically do the work that you're doing, you know, this semester on a competitive intelligence analysis, and break that down to understand what was driving their results. So when we compared our financials to their financials on an apples to apples basis, we could really drill in on the aspects of maybe one of our competitors' businesses that was more successful or more profitable, or understand why they had more pricing power in this market or that market. So, and we'll get to all that. But let's start with the DuPont analysis. You can see the basic breakdown of ROE here. We're going to take return on equity, and we're going to set that equal to return on assets, net income divided by average total assets. Nothing complicated about that equation. And then we're going to multiply that by a measure of financial leverage. And you can think of financial leverage as an accelerator to return on assets. If we take a return on asset number and we add a little bit of leverage, meaning we take borrowed money and we put it to work inside of our business and we make a return on that money, which is the whole idea of business, the more successful we are at that basic proposition, the more we can accelerate our return on equity. So it's not uncommon to see a company with a return on assets of say 10% and a return on equity of say 20%. The primary difference there is going to be financial leverage, which is borrowed money. That's a very simple concept. So get to know that basic equation, and we will draw that out a little bit. So return on assets, this slide breaks it down. This last point on this slide is the most important to me when I think about return on assets, which is ROA analysis encourage managers to focus on both the income statement and the balance sheet. So think about return on assets as the return to the business if we didn't have any leverage. So this is just the business by itself. If we could just isolate the assets that bring revenues in, take the raw materials and turn them into finished goods, send those widgets out the door, collect the monies, the basic proposition of business. If we just had that, how solid are those returns? That's the return on assets. And later you're going to see the corollary there as return on operating assets. And you'll also hear that referred to as return on invested capital. It took me a long time in my career to understand that return on invested capital and return on operating assets is the same thing. And that's one of the more frustrating aspects about finance, is that we have a lot of terminology that means the same thing. Those two are interchangeable. Our authors show a strong preference for return on net assets, so we're going to use that terminology primarily in this class. I just want you to know that when you get out there into the real world, especially if you're dealing with anybody who came through their MBA program around the same time I came through my MBA program, it was return on invested capital that was receiving most of the focus. So if you hear that, don't be intimidated. Okay, simple calc showing us that the median ROA for S&P 500s is around 6.1%, ranging from 5 to 6. Again, that's an expansionary market, so that helps us kind of contextualize that a little bit. Boston Scientific, which our authors are using here, is 8.35. And these are all right from the financials. So that's job number one for our semester research project, is go find the financials. If you're doing work on, I don't know, Apple, Google, whatever company you picked, go find the 10K filing. That's where these numbers come from. They're not hard to find. You can pull them up on Yahoo, you can pull them up on Google. Morningstar makes it really easy. And as a matter of fact, you don't even have to do the math. I want you to be familiar with these formulas. You're probably going to have a couple of homework assignments on the formula, but these numbers are easy to find. Just look them up on Morningstar. Okay, financial leverage. Again, part of my job is to simplify this to the extent I can. I laugh because I have a reputation at the office for making things more complicated than I should. But in this instance, I think I can simplify financial leverage to the very simple concept of how much debt do you have? And it's really how much debt do you have relative to the equity on your balance sheet. So when you start a business, usually if you're a sole proprietor, you open your own wallet and you chip in a few $1,000. Maybe you borrow a few $1,000 from the bank. If you got $1,000 worth of borrowed money and $1,000 worth of your own money, then your financial leverage ratio is 1 to 1. And total assets here over total equity is going to show you how to compute that financial leverage number. Okay. Boston Scientific has a financial leverage number of 2.54. S&P 500 firms usually range from 2.46 to 2.74. If your company has preferred stock, you'll need to take that into consideration using this formula here. It's a subtle nuance. It's not complicated, but you do have to be mindful that it can affect your return on equity, and it's really return on common equity. So in this class, we're focused on the return to common shareholders. That's going to give us the ratios and data that's relevant to you as the shareholder when you go into your Fidelity account or TD account or Schwab or wherever you buy stocks and you buy a share of Apple. Well, that makes the meaningful number, the return on common equity. And to get the return on common equity, you would take the net income as reported on the income statement, and you would subtract any preferred dividends. Now, maybe some of you won't have any preferred dividends, and that makes this easy. But if you do, you're going to want to make sure that when you're going through any analysis that you're paying attention to the return to common equity shareholders. And then the denominator is pretty simple. You just subtract any preferred equity from the equation and you'll be good to go. Okay, sometimes you see a similar wrinkle when we're looking at the return to controlling interests. And the difference being that sometimes you will see a line item on the income statement or balance sheet that attributes some amount to non-controlling interests. So if you have a conglomerate or a parent company that has bought a subsidiary, that's when this would show up. If they don't buy the subsidiary outright, meaning that they don't own 100% of the subsidiary, then you may see a non-controlling interest. That is the interest associated with the minority shareholders of the firm that was bought. And you'll see total income to the consolidated entity. And then on the income statement, you will see less share of income related to non-controlling interests. So what you need to be aware of, and we'll talk about this later in the semester, and we'll take a deeper dive into the accounting for that, and I'll show you how it all comes together. But what you need to be aware of for module number 3 here is that just like the return on common equity, when we're calculating ROE, we need to make sure that we're using the net income attributable to company shareholders, meaning we're going to disregard anything attributable to minority interests. Same story for the denominator. Those two things are not likely to show up in the homework. They may show up on a multiple choice type exam question. If they do, I expect they're probably going to be pretty easy questions. That was module 3. Those are questions that wouldn't take you too long to look up. I think you probably lean on the text for something like that. So we disaggregated return on equity into return on assets times financial leverage. Now let's look at return on assets and disaggregate that into profit margin times asset turnover. Now, profit margin's a pretty simple equation. We're just going to take net income and we're going to divide by sales. And I think profit margin's a pretty explainable concept too, right? Where profit margins is, how much money are we making? We're going to divide that into total profit. Asset turnover, some of you might not have come across that concept before. Basically, that equation takes sales and divides by total assets. And what that tells us is how many dollars worth of sales does each dollar's worth of assets that we have in our factory or in our machine shop generate in sales. And what we want to try to do as a management team is get this number to be as high as it possibly can. If we go build a new factory, we want to set that up in such a way that we can generate the most sales volume that we can possibly generate from that factory. And I want you to think Henry Ford here. When Henry Ford built the first assembly line, what do you think he did to asset turnover? Well, I'm hoping if you're listening and following along at home, you're thinking to yourselves, well, that asset turnover ratio just went through the roof. When we built the first assembly line, nobody had ever gotten more productive use out of their assets before that assembly line came into feature and into, I guess, the modern era. And you can probably think of another dozen instances of that over time where we made great leaps in productivity. And those leaps in productivity can be tremendously profitable from a return on asset standpoint, and that's asset turnover. So pay attention to what your companies are doing from an asset turnover standpoint. How are they maximizing the volume of sales from their property, plant, and equipment? If you're Intel, what Intel did for years and years and years and years, and they've kind of reached the maximum use case for this, but they would build these multi-billion-dollar fab facilities, and they were increasing the number of transistors that they could get on a little chip. This went on for decades, and we were down into the nanometer scale. And every time they built a new fab, they would take that wafer size down from 45 nanometers to 30 nanometers to 15 nanometers, and now I think they're down to 5 nanometers or less, or they definitely have plans on the horizon to go there. Well, with each of those changes, you would see the asset turnover ratios go up and the return on assets go up, and counterbalanced a little bit by the competitive, how competitive they were in the marketplace. But Intel's a fascinating case story. Okay, I love this graphic. This tells us everything that we're diving into in module number 3. You might just star it. If you go to the book, let me turn around here and go to the book. I dog-eared a page that I thought might be useful to all of you. I want to point it out. It is page 3.13. Okay, now let me get out of here. Got to get out of my PowerPoint, go back over to the internet, go to 3.13. Okay, here it is. Here's your cheat sheet. So if I were you all studying for a multiple choice test here in a couple of weeks, I would make a copy of this or dog-ear it, or just make sure that I had it up when I was taking the exam. And you have all of the ratios that we're going to be talking about tonight, all of the ratios that I expect you to calculate for your research projects, and how to compute them, what it means, what the positive indicators are, what the negative indicators are. So you got how to compute it, what it means, and then kind of some guidance on how to interpret it over time. Great chart. I think it would make a good cheat sheet for all of you. Not that you need a cheat sheet on an open book exam, but just wanted to point that out because it's not in the slides. Okay, back to the PowerPoint. So loosely, these ratios break down. Return on assets is profitability times productivity. And we just spent 5 minutes talking about profit margin and asset turnover. Well, asset turnover can be looked at a myriad of different ways itself, because there's all sorts of assets. There's accounts receivable, and if we take accounts receivable divided by sales, we can We can understand how many dollars worth of sales is being generated by each dollar's worth of accounts receivable. You can do the same thing for inventory, accounts payable. Those three together allow you to calculate something called the cash conversion cycle. And you can also look at property, plant, and equipment turnover, which is similar to asset turnover. And then there's a couple of ratios out here associated with financial leverage. When we get to looking at financial leverage, these are ratios that banks like to look at. Okay. So let's talk about gross profit margin. When you're looking at a company's gross profit margin, I want you to look at it relative to the industry. So go out on Morningstar, and if you're looking at General Motors, for example, I want you to understand what General Motors gross profit margin is. But then I also want you to understand what the gross profit margin is for Ford and Toyota and Tesla and Daimler Chrysler and Volkswagen, the whole industry. Be able to identify any differences and what drives those differences. And that's going to give you a lot of competitive intelligence, and it's going to help you. It's really going to help you ask meaningful questions about the future strategy and positioning of the company that you're taking a look at. And what you might find is you don't like the company that you're looking at. You might figure out that you think Toyota is a much better run company than GM. And if Toyota is a much better run company than GM, and you can get it for about the same price, well, there's your buy signal. You want to buy Toyota. So this analysis unfolds across many perspectives. And one of those perspectives is across industry. So look at gross profit margin across industry. And then I want you to look at gross profit margin across history. And for all of these ratios, I want you to do the same thing. Look at how it's trended over the last decade. And that's why I set this screen up on Yahoo to identify companies that had lengthy historical track records, because you need to be able to understand the trends. And as you see it move up and down across time, that's going to show you where you need to be looking. And you need to be asking the question, why? Why has gross profit margin done this or that? Or okay, hold on a minute here. Okay, I'm roasting. I gotta stop my video and take my sweater off. Okay, thank you, appreciate that. As you identify those variances in gross capital, gross profit margin, these are the general causes of what might push those fluctuations up and down. So competitive intensity has increased. That's going to drive gross profit margin down, especially for any industry that's competing on price. The product may have lost its appeal. You see that a lot of times in retail, where you get to the end of a season and maybe something's just not in fashion anymore, or you have some spoilage. Product costs have increased, typical inflation, product mix, volume, so on and so forth. It's your job as the analyst to be able to identify the reason why. Operating margin expense. I like this chart just because it gives you a little bit of perspective on what's going on with the S&P 500. Look at this. Operating margin expense, it's the expense margin. So this is not how much money we're making, this is how much money we're spending. To what degree does operating expense margin comprise total revenues? So if you had gross margin and then you subtracted the operating expense margin, what you're going to be left with is net margin. So look at the way that's trended over time. You go from 9 to 10 to 11 to 18. The expense margin has gone from 19 to 16. So the net margin is really just going to look a lot like the inverse of this. And what we've observed over that time period is that corporate America has gotten more profitable and more profitable and more profitable and more profitable. And what could be driving that, you might say? Any guesses? No guesses.
Decrease in labor costs?
Decrease in labor costs. Well, they certainly haven't been going up. So yes, there's been very little inflation in the market for the last decade. That's just started to change. We got a 5% print in May, 6% print in June. I think it was 5.5-ish in July. I forget. But yes, inflation is starting to creep in. Now, a lot of that's COVID, because if you take the 5% increase year over year and you drag it back to 2019, it still looks pretty manageable. And the Fed has said that they think some of those numbers are going to be transitory, was the word that they used, which means manageable in the short run. But another big driver has been federal stimulus. So think about what happened in 2009. You had that big bear market. It was the great financial crisis, ended in 2009. It was March 6th of 2009 that what happened on March 6th? Maybe it was March 3rd. I'm getting my dates confused. Alan Greenspan came out and suggested that we should let one of the major banks fail. And that sent the market into a tailspin. And it spooked the Treasury Department, and it spooked Congress, and it spooked every investor in the world. 3 days later, the Obama administration, really Ben Bernanke and his Fed, came out and said that they were going to bail out all the banks. And they put a backstop underneath the banks, and they embarked on a money printing campaign that dwarfed anything that we had seen in the last 1,000 years. And the Federal Reserve balance sheet tripled over the course of the next decade. And that lasted from 9 to 10 to 11 to 12 to 13, when it started to moderate a little bit going into 14 and 15. But the market was in an expansionary period. And then we moved into COVID last year. And with the COVID stimulus, we added another 4 trillion into the economy. And that sent interest rates into negative territories. And it made it so cheap for companies in the S&P 500 to borrow that they started borrowing hand over fist. And we just broke down the return on equity. Well, return on equity is return on assets times financial leverage. And financial leverage is an accelerant. So when you have all that free debt sloshing around the economy, you see margins do exactly what they're doing on the screen here. And corporate America just ends up making a ton of money, which, now that's a political football. It happened. So that's kind of the state of things. That's just the truth. If you look back through time, that happened. Now the question is whether or not you agree about it, whether politically we need to take corrective measures. Do we need to increase taxes on corporate America? It has exacerbating a rising wealth gap. Is that a good thing? Is that a bad thing? I don't know. This is not a class on politics, but I think it's important for everybody to understand that politics has a huge influence over economic cycles, and economic cycles have a huge influence over corporate profit margins. And because we haven't seen a severe bear market now since 2009, I think a lot of investors have been lulled into thinking that this is a normal environment. Well, this is not a normal environment, because normally you don't inject $4 trillion worth of new currency into a market. So if we ever do hit a quote unquote normal environment again, and we see a economic recession and or a bear market, you're going to see margins contract significantly. So as we progress through the semester, we will ultimately end up doing a forecast. And I think it's incumbent really upon everybody in this class to recognize that, well, you probably don't just want to do a trend line forecast, meaning, well, gross margins have been at 20% for the last 5 years. I think they'll be at 20% for the next 5 years. That's a little bit naive and doesn't take into account an accurate historical perspective. Notwithstanding, I think you'll probably come to find out that that's what most Wall Street analysts do. So take all of their estimates with a grain of salt and just recognize that they're a bunch of lemmings by and large. Okay, moving into these productivity ratios. We're going to look at accounts receivable turnover. Pretty simple. Sales divided by accounts receivable. Inventory turnover, cost of goods sold divided by average inventory. And accounts payable turnover, cost of goods sold divided by accounts payable. And you'll look at these. That's why I point out that cheat sheet. Come back, review them. Generally know that the higher those ratios are, the better. I'm just doing a time check here. I have about 20 minutes left in this class and 60 more slides to go. So I want to kind of cherry pick the slides and make sure I give you the right ones. Make the best use of your time. I'm going to switch views here so I can see the upcoming slides and skip around a little bit. I do want to talk about cash conversion cycle. I think it's an important concept. It's informative for me as an analyst to know what the cash conversion cycle is. And the authors give us a great example of one in Apple. So take a look at the inputs. Days sales outstanding. How long does it take us to convert $1 worth of sales that's accounts receivable? So sold on credit. How long does it take us to make that sale and then collect those real dollars? That's called accounts receivable turnover. Add to that inventory turnover, which is 365 divided by inventory turnover. How long does it take us to take a dollar's worth of, raw materials and get it through our manufacturing line and sold? And then lastly, days payable outstanding, 365 divided by accounts payable turnover. So how long does it take us to collect raw materials on credit and then pay those invoices to our original equipment manufacturers? That's called the cash conversion cycle. And from end to end, it tells us how long it takes us to get paid. Well, what we prefer is a lower cash conversion cycle. And if you're a company like Apple that has incredibly strong bargaining power nationwide with all of its original equipment manufacturers, you can actually drive that negative. But before I talk about that, look at where most companies are in the S&P. If you're healthcare, that's about 100 days. Well, why do you think that is? It's because I would guess that's because nobody in healthcare pays their bills. When you go to the doctor, that's the easiest bill to delay, right? I mean, you go to the doctor, they send you a bill. There's no consequences for delaying medical bills. Medical bills don't show up on your credit report. Generally speaking, there's a prohibition against medical bills affecting your credit report. So where's your incentive to pay? Industrials, information technology. How about utilities? Well, utility bills don't have any problem collecting. They'll just shut your power off. So they have a little bit more power over when they get paid, and those dynamics influence the cash conversion cycle. Now take somebody like Apple as an example and think about how Apple does business. They're so big, they have so much scale. They were the first $1 trillion market cap in the world. Everybody wants to do business with Apple. They've negotiated such favorable terms, they actually have a negative cash conversion cycle. Now, what does that mean? That means that they buy phones from China based on a promise to pay them later. They sell the phones to stores in the United States. They get paid immediately. They wait 73 days on average, and then they send the cash back to China. That's an oversimplification, but the point is that on average, they hold that cash for 73 days and they can put it to work. When you're a company like Apple, that's free borrowing. If you have a multi-billion-dollar balance sheet, well, and it's bigger than that, it's tens of billions of dollars that they're running through their inventory cycle on a quarterly basis. So you take $10 billion and put that to work at a couple of percent. Yeah, it's probably a whole team's worth, it's probably a whole team of analysts that gets paid to try to figure out how Apple can take that cash conversion cycle from 73.6 to 74.6. And if they can do that, that's gonna, I guarantee you that's gonna be enough to pay all their salaries for a year. Okay, we don't need another example in Merck, so I'll jump down here and just touch on analysis of property, plant, and equipment. Same basic ratio. Now we're just looking at property, plant, and equipment turnover. And that's going to vary based on new facilities. That's going to vary based on the financing. It could be a sale leaseback. That's going to vary based on M&A activity, joint ventures. All these bullet points on this slide are relevant. So just star those, put those to memory, understand the different things that can affect that ratio. Okay. Okay, I'm going to jump down to operating focus. This is where I said that it gets complicated. When we look at the DuPont method, you're looking at the entire balance sheet and the entire income statement. Some of you may have management teams that get paid based on operating assets, and that's fair. If you're a manager, maybe you manage a division of inside of another company. You don't have any say-so over how much of that company is dead or how it's financed or anything related to the non-operating operations, like anything that's non-core to the business. Say maybe it's Procter & Gamble and you run the Tide facility and you spend all day in their Cincinnati facility researching, how to make their Tide clean better in cold water. And you run that facility and you're the manager of that. Well, you want to make sure that your incentive compensation plan links you to something that you can control. And what you can control is the return on operating assets. That's what's in your domain. That's what's in your purview. You run the business. There's a whole bunch of bigger conversations, M&A, financing, that are germane to the board, maybe the CEO. But a lot of the managers inside the company, they're more concerned about the return on operating assets. So that's why we segue into this operating focus to ROE. So we're going to take the same basic concepts, but we're going to identify the operating assets from the non-operating assets of the business. And then we're going to focus on the operating side. And I think as we go through this a little bit, you'll see how that can be informative, and differences between returns to operating assets and returns to non-operating assets can help us make decisions about how we want to operate the company in the future. So I think I touched on all these points, but return on equity equals the operating return plus the non-operating return. And for all the reasons I just mentioned, the operating return can be informative. That's the return to operating assets, and it's earned from the operating assets and liabilities. Okay. So let's draw the distinction out a little bit further here. This is the same basic equation that we just looked at with the DuPont method. That included all liabilities. In this new operating focus, we're going to make the distinction between operating liabilities and non-operating liabilities or borrowed money. Operating liabilities include normal accounts that every business has to sustain operations, regardless of whether or not they choose to borrow money from the bank. So accounts payable, these are interest-free, these are self-liquidating. Non-operating liabilities would include major loans. They're interest building, they're contractual in nature. The bank typically has recourse. There's collateral associated with them. That's the distinction that we're making here. So the basic formula for return on net operating assets is net operating profit after tax, which we will call NOPAT, divided by average net operating assets. And if you go to your text, I'm not going to take you there right now, just because we're bumping up against the end of class. But just like I pointed out that that good crib sheet for all the ratios, there's another good crib sheet for the differences between operating and non-operating assets. If you look at the balance sheet, that's a very common question in this class, which is how do I know if a line item is operating or non-operating? And there's some there's a page in module 3 that helps with the categorization and breaks down the most common occurrences. Notwithstanding, as you get into your semester case project, you're going to run into some line items that you just can't tell. You're like, how do I know if this is operating or non-operating? And you don't know. So you're going to have to dig into the footnotes. And hopefully there will be a description of exactly what that is. And then based on the description, you're going to have to come to some determination about whether that's core to the operating nature of the business or ancillary, operating or non-operating. So I think we're looking at Boston Scientific here. That's been a pretty common theme throughout the semester. You can see that the authors have gone through this, this balance sheet and highlighted all of the operating assets red here. So you have inventories and accounts receivable, prepaid income tax, property, plant, and equipment. Yeah, of course, accounts receivable, accrued expenses, all those are operating. They do not, the long-term debt is in black there, so that's non-operating. Most of these are pretty self-explanatory. And by adding all of these up, we're building the basic building blocks, or identifying the basic building blocks that we're going to use to just kind of pre-populate into that formula that was on the prior slide. And then it just becomes a, plug and play algebra assignment. You can calculate the ratios just like we did ROE. Oh gosh, maybe this is what I was thinking of. My brain's not functioning here. This is a pretty good Appendix 3A, and I think this was in the book too. But you can see, just a quick shot of what's operating and what's non-operating. So same way for the income statement. We just took a look at the balance sheet. Now let's look at the income statement. Net operating profit after tax is what we're after. To get that, we're going to take the net operating profit before tax, and we're going to subtract the tax on operating profit, which is not the same thing as tax expense. Tax expense you can find on the income statement. This is not that. Tax on operating profit is something different, and I'll show you the difference. So you can see here on slide 45 all the things that are generally included in net operating profit. But fortunately for us, net operating profit usually shows up right on the income statement. So operating income, which is great. That makes our job easier because half of NOPAT is just given to us. Net operating profit before tax, right there on the income statement. Terrific. Now we just have to calculate the tax effect, which is different from interest expense or tax expense rather. This is how. So we talked about NOPAT and the net operating profit before tax. We take that directly from the income statement. And then we want to subtract the tax on operating profit. Well, the tax on operating profit is down here where we're going to take the tax expense. This is an income statement line item. And we're going to add to that the pre-tax net non-operating expense times the statutory tax rate. So think of this like the interest tax shield. I suspect that most of you in this class probably ran across the interest tax shield once or twice in finance, once 101 or another class. Anytime we're trying to create a pro forma or an apples to apples comparison of something that is financed with debt versus something that is financed without debt, we have to remove the effects of leverage. So we subtract off all the debt, and then if we paid any interest, we subtract all the interest off, and then we say, hey, wait a minute, that interest was a tax shield, meaning that we had a profit and we would have paid taxes on that whole profit weren't it been for the interest expense, because we subtracted that from the profit before we paid tax. A little bit of a complicated explanation, but the simple algebraic adjustment, you might say, is right here, where we take that non-operating expense and we multiply times the statutory tax rate. And that adds back the tax shield. So that adjustment is calculated for us here on the next couple of slides. When we look at Boston Scientific again, we take their interest expense, which was 241. We subtract 156 and we get 85, which is our non-operating expense there. And we're going to multiply that times our statutory tax rate on the next slide. So here's Boston Scientific's NOPAT, where we take our tax expense of 1506. Is that right? No, tax expense was 249. So this was net operating profit before tax of 1506. Then we took our tax expense from the income statement of 249. That was actually a tax benefit. This is a horrible example. The authors, they want to stay consistent to Boston Scientific, but they're using an example of a company that has a tax benefit, which is bizarre. That doesn't happen very much in real corporate America. They might have had a huge tax credit from the year before. This basically implies that the IRS is writing them a check. So I'm faulting the authors here for even using this example. It's a little far-fetched. I mean, it really happened, but it's not the norm. So just recognize that. And then we're going to produce a tax shield on that. So in this instance, the tax benefit dropped from 249 to 230, and that results in a NOPAT of 1736. So if you recognize that the tax benefit is not the norm, I think you can walk through that step A, step B, step C, and understand how to calculate a NOPAT. Okay, it's 8:13, which means I have 2 minutes, and I did not make it to learning objectives 6, 7, or 8. But I will say this, given that operating focus, learning objective number 6 basically goes through the exact same steps of disaggregating ROE. They just do it using operating metrics. So the structural flow of the lecture and the slides and the material is exactly the same. Go back to the text, utilize the bite-sized video segments that I pointed out at the top of class, and I think you'll be fine for learning objective number 6 and number 7. And then I covered number 9 already earlier. That was a very simple one. That one, learning objective number 9 was on historical analysis and prospective analysis of operating ratios and other financial ratios. And then number 8. Okay. Since we are at time, I'm going to give you some homework. Do it, don't do it. It's not graded. But come out here to 3.36 in your text and click on this. Wait a minute, it's not. There it is. 3.34 in your text and click on this lesson number 8.
In this segment of our
It's 12 minutes. I didn't make it to this section of the PowerPoint slides tonight. This will be a good 12 minutes of your time. It's not terribly complicated. I don't have a lot to add to that section, but it's just complicated enough that I don't want to skip over it and shortchange you guys. So having said that, we are at time. Anything that came to mind while I was yapping that you want to ask a question about before we adjourn? Okay, I'm getting crickets. Thanks, you guys. I'll let you get back to your Monday Night Football. It's a good check-in. See you next week.
Hey.
I won't
Thank
see
you.
you next week. It's YouTube. See you in 2 weeks.
Thank you.
Yep, thank you.